Hello, this is John Linneball of John Linneball Tutoring, and this is how to study for the SAT and ACT math sections, Business Math Like a Boss. If you like this video, please subscribe and please like this video and share it with your friends. So here are some things you should know like a boss. First of all, what we're going to do is go over some math concepts like profit, return on investment, progressive taxation and tax brackets, effective tax rate, compensation, deferred compensation, and pre-tax dollars. So we're planning like a boss. So first of all, percent change is really the underlying idea behind profit, return on investment, sales, etc. So percent change is always going to be the new value minus the old value over the old value times 100%. For example, if sales are 1,200 units this year and they were 1,000 units last year, the percent change is 1,200 minus 1,000 over 1,000 times 100%, which is 20%. You might also recognize this from when you do percent error in chemistry or physics class or percent yield. So you would take the value that you found minus the generally accepted value over the generally accepted value, the true value, times 100% for something like that. So profit is also percent change. For example, you know to make a profit, you have to spend money, so you're going to have expenses. So here in this diagram, we can see sales of your product minus the expenses it took for you to actually market, distribute your product is going to be your profit. So your profit is going to be the money you made, your total gross income, minus the money spent over the money spent. So then you're going to multiply that times 100%. So it's just going to be the same thing as the percent change. This is the money made minus the money spent over the money spent times 100%. So if you made $1,200 in sales, but you paid $1,000 for the goods, your labor, rent, etc., all your expenses, then the profit again is going to be $1,200 minus $1,000 over $1,000, which is going to be 200 over 1,000 times 100%, which is 20%. So we just use the same numbers as in the previous problem. Return on investment is also percent change. So return on investment is going to be the current value of whatever investment you have minus what the investment cost you over the cost of investment times 100%. So if your stock in Spurious Corporation is worth $1,200 right now, your return on investment would be $1,200 minus the $1,000 that you spent on it over 1,000 times 100%, which is 20%. So again, using the same numbers, you could see you could have those numbers as the numbers in a profit problem, the numbers of return on investment, or the numbers in I'm going to change it. I'm going to change it. Lots of other things. So, interesting. Math you can take to the bank. Ha ha ha. Okay, simple interest is the most common SAT interest problem. It might be in a problem like this. Sally Saver puts $100 into a savings account that earns 3% simple interest per year and makes no further deposits or withdrawals. At the end of 3 years, how much money is in the account? Well, at the end of the first year, Sally's account has 1.03 times as much as it did at the beginning, which is $103. At the end of the second year, her account has $103 times 1.03, because that's going to be 1 plus 3%, which is 106.09. At the end of the third year, she'll have $106.09 times 1.03, which is $109.27 to the nearest cent. Another way to do this is just to recognize that the interest compounds every year, so that the amount would be 100 times 1.03 to the third power, which is 100 times 1.092727, which is approximately $109.27 when you round it to the nearest cent. So let's talk about compound interest. Compound interest is basically how saving helps you and how credit cards can hurt you. When interest is compounded, it's added to the principal that has the original amount of money saved or lent, then interest is charged on top of the principal and compounded interest. Let's use a compound interest calculator to figure this out. First of all, The compound interest formula is C equals P, which is the principal, times 1 plus R, that's 1 plus the rate, to the nth power, which is the number of periods, number of times that we're going to compound the interest, minus 1. So let's pick an average credit card rate. For example, the average credit card APR has hit a record high of 17.55%, so let's go with that. 17.55% is going to be used in the formula that we just showed you, this compound interest formula. Now, most likely the SAT or ACT people would give you the compound interest formula. They're not going to expect you to know it. And also it will be on the calculator section on the SAT. They're not going to expect you to be able to take something to the 365th power. So the problem might be something like, how much more does a credit card holder pay on $1,000 at 17.55% interest compounded daily than a borrower taking out a loan that charges 17.55% simple interest per year? So we can calculate the compound interest that accumulates on $1,000 at 17.55% annual interest compounded daily in 1 year. But first, let's do the simple interest because it's simple. It's really easy. 17.55% simple interest on $1,000 borrowed for a year is just $175.50. It's $1,000 times 0.1755. Okay, there. The compound interest would be C equals 1,000, which is the principal, times 1 plus 0.1755, which is the annual interest rate, over 365. We're going to assume it's not a leap year, it's just a regular 365-day year, times, or to the 365th power, minus 1. Again, they're not going to ask you to actually do this without using a calculator. So I'm going to use my calculator here, and we're going to do something like this, where we're going to go 0.1755, divided that by 365. Okay, now we need to add in the original principal, which is, we're going to clear that, plus 1 is 1.0 and then we're going to take that to the 365th power, and we get that. So then we're going to subtract 1 to get rid of the original principal, and then we're going to multiply that times $1,000. Whoops, not 10,000, 1,000. So voila, we get 191.7917. Obviously, we're going to have to round it to the nearest penny, so that's just $191.79. So then we just subtract 175.50, the simple interest amount, from 191.79, and we get $16.29 as a difference, so the borrower paid an extra 1.629%. So you can see how compound interest helps banks out. Now imagine that millions of people are all doing this, paying that extra interest to banks, and you can see why banking can be very profitable. The next issue here is foreign exchange and sales tax. Foreign exchange is basically how much money from different countries is worth relative to each other. Different countries' money is worth different amounts. Some countries' money is considered to be more stable and less likely to lose its value, so it's worth more than countries' money from countries that have weaker economies, I guess you could say. So, for example, when I went to Great Britain recently, a pound was worth about $1.30, so the exchange rate was 30%. Sales tax is, of course, a tax on retail goods, sometimes services, which is usually a percentage of the original price. So if you buy something that costs $1 and there's a 10% sales tax, you're going to pay an extra 10 cents in sales tax on it. Makes sense, right? All right, so let's do a foreign exchange and sales tax problem. All goods and services sold in the Canadian province of Ontario are subject to 13% sales tax. There's a 32% exchange rate in the U.S.'s favor. So Tommy Tourist, an American citizen, travels from Buffalo, New York to Toronto to see a hockey game and buys a dozen donuts at Tim Hortons in Toronto at a cost of $8.99 Canadian. How much money in U.S. dollars did Tommy pay, including the sales tax? Assume that the Tim Hortons will convert money at exactly the exchange rate with no conversion fees. Most Canadian retailers are actually very good about giving you the exchange on American money when you spend it there. Let's solve the problem. We know that $1 US is equal to $1.32 Canadian. We also know that the donuts cost $8.99 Canadian and are subject to a 13% sales tax, so the donuts cost $8.99 times 1.13, which is 10.16 Canadian. 10.16 Canadian divided by the conversion factor of, or exchange rate of 1.32 Canadian over $1 USD equals $7.70 USD, US dollars. So now let's talk about progressive taxation. Progressive taxation means that the more you make, the higher part of your income is taxed, which means everyone's taxed at the lowest rate until their income reaches a level or a bracket above the first level. Then that next portion of income is taxed at a higher rate until you reach an even higher bracket, and then you're taxed at an even higher rate, and so on. So here we have the 2018 federal income tax brackets for people filing single. So 10% applies to 0 to 9,525, so you pay 10%. So up to 9,525, you're going to pay 10%, and you can see that's going to be $952.50. Everything between $95.26 and $38,700, you pay 12%, so that's going to be 12% of that amount. Then from $38,701 to $82,500, it's going to go up to another level. So let's go and do a little problem here. So let's avoid this common misconception. People often think that a taxpayer's maximum tax bracket is the tax rate applied to all the taxpayers' income. So when AOC said the tax rate was, once we reach the $10 millionth dollar, should be roughly 70%, smart and educated people I know were posting comments online saying things like, if you worked hard enough to earn $10 million in 1 year, you shouldn't have to give away $7 million. That doesn't work that way. Progressive taxation doesn't work and has never worked that way. You would not pay 70% on your entire tax bill, or on your entire income is what I mean.
And when you have a progressive tax rate system, your tax rate, let's say from 0 to $75,000 may be 10% or 15%, etc. But once you get to like the tippy tops, on your $10 millionth dollar, sometimes you see tax rates as high as 60 or 70%. That doesn't mean all $10 million are taxed at an extremely high rate.
So if you don't believe me, good, let's do the math. Under the current tax plan, a $10 million earning taxpayer would pay 10% of his income or her income up to $9,525, $925.50. So that's the same as anyone. Then 12% from the amount from $95.26 to $38,700 is 12% of $29,175, which is $3,501. Then you pay 22% of the amount from $38,701 to $82,500, which is $43,800 times 22%, which is $9,636. 24% of the amount from $82,501 to $157,500, which is $18,000. Then 32% of the amount from $157,500 to $200,000, which is $13,600. Then from $200,000 to $500,000, you pay 35%, which is $105,000. That's 35% to $300,000. And then 35% of everything that's $500,000 or more. So that would be 37% of $9.5 million, which is $3,515,000. So if you add all these numbers up, $3,515,000 plus $105,000 plus $18,000 plus $13,600 plus $96,36 plus $3,501 plus $925, you end up with $3,665,689.50 in taxes. So notice that you wouldn't pay 70% on anything because under this, in quotes, tax plan, you would only pay 70% starting with everything over $10. So you would only pay 70% even under the AOC tax plan once you earned more than $10 million, and you'd only pay it on that amount. So the AOC tax plan, and the reason that I put it in quotes is it's more like an aside in an interview. So even if you added her hypothetical 70% tax bracket, it wouldn't kick in until the $10 millionth dollar, so the tax would be exactly the same. Okay, so let's say our taxpayer earned $20 million instead of $10 million. So under the current scheme, the taxpayer would pay $3,665,689.50 plus 37% of the additional $10 million, which would be $3,700,000 or $7,352,662.50. Under AOC's plan, and again, come on, it's just a decide an interview, it's not a detailed tax reform plan. The additional tax would be $7 million for a total of $10,652,662.50. If it were really 70%, the taxpayer would pay $14 million, which is 70% of $20 million. Now, the effective tax rate is what you really pay in taxes, the real percentage, not the maximum tax rate. So the most straightforward way to calculate an effective tax rate is to divide the income tax expenses by the earnings or income earned before taxes. For example, if a company earned $100,000 and paid $25,000 in taxes, the effective tax rate is equal to $25,000 over $100,000 or 0.25, which is 25%. And that's from Investopedia.com from February 24th of this year. So an effective tax rate problem from the previous problem, what was the taxpayer's effective tax rate? That is, what percentage of his or her pre-tax income did he pay in tax or did she pay in tax? Let's take another look at the $20 million taxpayer. As noted earlier, under the current scheme, the taxpayer would pay $3,665,689.50 plus 37% of another $10 million, which is $3,700,000, which is $7,365,689.50. So the effective tax rate would be this over 20 million times 100%, which is 36.83%. Under AOC's plan, the additional tax would be $7 million for a total of $10,665,689.50. And when you divide that by 20 million, it's a little bit more than half, so it shouldn't surprise you that it works out to 53.33%. So a maximum tax rate is not the effective tax rate. A 70% tax rate doesn't mean the IRS takes away 70% of your income. As we've seen, we have progressive taxation. Also, there are tax deductions and exclusions that mean some income doesn't count. For example, business expenses. Remember how we talked about you have to spend money to make money? They're not going to tax you on the money you actually had to spend because you didn't really earn it, you spent it. Mortgage interest on your house, medical expenses, charitable contributions. Many of these things are often tax deductible. This isn't legal or tax advice. Please see a tax advisor, accountant, or attorney for tax advice. So deferred compensation, let's talk about that. Deferred means postpone or put off. Compensation is pay, so deferred compensation is payment you get from your job later, as in when you retire. Fun fact, some NFL football teams use deferred compensation to spend more on player salaries while technically not violating the salary cap. So accountants and lawyers can help win football games. I believe that's what the San Francisco 49ers did a long time ago when the salary cap first came out. So other teams, excuse me for a second, like the Buffalo Bills, whacked into high salary caps, whereas the Niners said, well, we can pay you this money as deferred compensation, so technically we're not paying it to you now, so it doesn't count for the salary cap purposes. So again, tax accountants and lawyers can win football games. Tax laws also encourage saving for retirement by allowing people to take out pre-tax money and put it in individual retirement accounts, IRAs, so it doesn't count as income when you save it, and it only counts as income when you actually spend it after you're retired. There are a few reasons why that's good. So how does deferred compensation help? Well, since the money's pre-tax, your taxable income goes down. So let's say you earn $90,000 gross before deductions in 1 year. However, you or this person, he or she, has had $10,000 taken out and put into a retirement plan. So instead of the tax rate being 24% on everything from $82,500 to $90,000, you can take a look at our chart that we looked at before. His or her maximum tax rate is 22%. So according to the tax chart, the tax on the $80,000 after the $10,000 IRA contribution would be $4,443.50 plus 22% of the amount over $38,700. So the tax would be $80,000 minus $38,700 times 0.22 plus $4,453.50. which is $13,539.50 with an effective tax rate of $13,539.50 over $80,000 times 100%, which is 16.92%. So according to the tax chart, the tax on the $90,000 with no deduction for the $10,000 IRA would be $14,809.50 plus 24% of the amount over $82,500. So the tax itself would be $90,000 minus $82,500 times 0.24 plus $14,809.50, which is $1,800 plus $14,809.50, which is $16,609.50, with an effective tax rate of $16,609.50 over $90,000 times 100%, which is 18.46%. So the IRS reduced the taxes, or the IRA reduced your taxes that you pay to the IRS from 18.46 to 16.92%. So that's pretty good. And the IRA is also helped by lowering taxes when you contribute, but also when you cash them out. How? Well, it's simple. Let's say the same person retired and now earns $10,000 per year doing odd jobs and $10,000 per year from his or her pension and IRA. The taxpayer's maximum tax bracket would be 12%, not 24%. So the taxes are $952.50 plus 12% of the difference between $20,000 and $9,525, which is $10,475 times 0.12 plus $952.50, which is $2,209.50. Divided by $20,000, that's roughly 11.05% effective tax rate. What's the downside? Let's say you need to access the money that you've put into this IRA before you are of legal retirement age. I believe that's 67 these days. You pay a tax penalty. So basically, they're not going to let you avoid taxes and then take the money back before you're actually retired. So they'll make you pay the taxes with probably some extra penalty attached to it. So let's have some sample problems. In the country of Nebonia, all income of up to 60,000 Nebonian dollars, or KD, is taxable at the rate of 25%. All income above $60,000 is taxed at a rate of 33.33%, that is approximately 1/3. Wendy Worker, a Nebonian office supervisor, earned $69,000 in Nebonian dollars last year. How much did she pay in taxes? Well, answer, she paid 25% of the first $60,000 and a third of the remaining $9,000, which is $15,000 plus $3,000, or $18,000. You can see 1/3 of $9,000 is $3,000 and 25% of 60 is $15,000. So what's her effective tax rate? She paid $18,000 over $69,000 times 100%, which is 26.09%. So suppose Wendy Worker put 10,000 Nebonian dollars in her KIRA, her Nebonian individual retirement account, in the year we just discussed. What would her effective tax rate be? Since she earned $69,000 but can exclude $10,000 from her income, she's officially earned only $59,000. Since that's less than $60,000, she's taxed at the lower 25% rate on her whole income. So her taxes are $59,000 times 0.25 over $69,000, which is $14,750 over $69,000 equals 21.38%. Presumably, Wendy would pay a much lower rate when she retired and has little or no income besides her pension. So I hope this helps. Please like and subscribe and click on the little bell thingy so you can be notified when I release new videos. All right, have a nice day.